Welcome to a deep dive, straight out of the corporate world. Today, we're taking a focused look at the recent earnings call from Swiss Life.
That's right. We're zeroing in on the key takeaways from their first quarter 2025 results, based only on what they actually discussed in that call.
Exactly. Our mission here is to cut through the noise, unpack the reported figures, try and understand what management emphasized,
And explore what it might signal, for the company and maybe the broader sector, all just from the call itself.
Okay, let's get into it. Management kicked off saying it was a, quote, good start to the year. This also marks the beginning of their new Swiss Life 2027 program.
Right, setting the stage. So looking at the headline numbers for the first 3 months of 2025, fee and commission income saw a solid increase, up 3% to 659 million euros.
And they pointed out where that came from, right?
Yeah, they did. It was driven specifically by contributions from selling their own and third-party products, across their distribution channels, plus a boost from their asset management side.
Then there's gross written premiums, fees, and deposits received. That's the measure they seem to prefer for business activity.
Exactly. And that was up 6% to 7.9 billion. Pretty robust.
And management made a point of saying all their business divisions chipped in to hit that 6% growth.
That's key, yeah. Broad-based growth. Direct investment income grew as well, up 6% to 1.1 billion.
Which worked out to a direct investment yield non-annualized of 0.8% for the quarter.
Correct. That's up slightly from 0.7% last year. It's basically the direct return from their portfolio over those 3 months.
Okay, now this next number really caught my eye. Swiss Life Asset Managers, specifically the third-party asset management part, PPM. The net new asset inflows were just huge.
Huge is the word. We're talking 9.3 billion euros in just Q1.
Compare that to what, 0.7 billion in the same period last year?
Yeah, it's a massive leap, and we'll dig into why later, but they mentioned capitalizing on, let's say, specific market events.
Right. And finally, the solvency picture. Their estimated SST ratio, that key financial strength measure,
stood at around 200% at the end of March 2025. So a pretty strong cushion.
Okay, those are the big picture numbers. A good start, as they said.
Right. But now let's take that deeper dive into the segments. This is where you really see what's driving those headline figures.
Starting at home in Switzerland. Premiums there increased 3% to 4.5 billion. Now, 3% might not sound huge, but
the context is important. The overall Swiss life insurance market was basically flat, unchanged, so they outperformed the market there.
Breaking that down.
Group life premiums grew 3%, while the market actually shrank 1%, and individual life grew 3%, which was roughly in line with the market's 4% increase.
Interesting dynamics within Switzerland, though, a shift in premium types.
Yes, exactly. Periodic premiums, the regular ones, they declined 4%, but single premiums, those lump sum payments, jumped up 12%.
And they link that jump to new business.
Primarily, yes, especially highlighting a new unit-linked product in individual life. Those products where the value tracks underlying funds. Assets in their semi-autonomous foundations were stable at 7.8 billion, and crucially for the Swiss segment, commission income was up a strong 11%, driven heavily by those unit-linked products and also their mortgage business.
Okay, moving over to France. Very strong increase there, premiums up 11% to 2.1 billion.
Yeah, France was definitely a standout. The life business within France grew 14%. Compare that to the market average growth of just 4%. Big difference.
And their unit-linked share stayed high.
Very high. Stable at 65%, way above the market average, which is around 41%. That's significant because, unit-linked usually requires less capital for the insurer.
Life net inflows were positive, about 0.7 billion. Though the market saw much larger inflows overall.
True. Market was 14.4 billion. Protection premiums were solid, up 5%, mainly due to price increases, pretty much tracking the market 6% growth. Property and casualty, P&C premiums did decrease slightly, down 2%.
And fee income in France
rose 7% to 154 million. Again, thanks largely to that high unit-linked book and the net inflows supporting it. They did flag lower revenues from structured products, though, called it a more normalized income contribution compared to some very strong prior years. So maybe less upside from that specific area going forward.
Got it. Let's look at Germany. Premiums grew 3% there to 412 million, focused on modern products.
Right, but the overall German market grew much faster, up 16%. Seems that was mostly driven by higher single premiums across the industry, not just Swiss Life.
Fee and commission income in Germany rose 5% to 227 million. What was behind that?
Management pointed to a higher contribution specifically from the insurance business part of that fee income. Now, income from their owned IFAs, the financial advisors, looks stable compared to a very strong Q1 last year.
But there was a catch there, wasn't there? A one-off effect last year?
Exactly. They clarified Q1 2024 included a one-off benefit, about 25 million euros from some government inflation compensation thing. So if you strip that out,
The underlying income growth in Germany this quarter looks more like, what, 7%?
around 7%, yes, which paints a healthier picture of the underlying business.
And what about the advisor numbers in Germany? Still hovering near 6,000.
Stable year on year, yeah, close to 6,000. But they spent some time on this in the Q&A. They emphasized they're actively recruiting, making progress towards their 2027 target of over 7,200 advisors.
So the pipeline looks okay.
Seems so. They mentioned total sales reps, including trainees, grew 3%. So a pipeline is there, although it takes time, 15 to 22 months, they estimated, for trainees to get fully certified. But combine that pipeline growth with the underlying 7% income growth, it suggests they're getting more productivity out of the existing advisors, too.
Okay, on to the international segment. Premiums up 7% to 1.1 billion, both private and corporate clients contributing.
Right. But fee and commission income here was the only segment showing a decline, actually, down 5% to 92 million.
Why was that?
Well, they said higher income from their own IFAs in this segment was more than offset by a drop from corporate clients, specifically mentioning Elips Life.
Elips Life. They clarified that in the Q&A, didn't they? Something about reinsurance.
Yes, good catch. They explained the existing backbook of policies from Elips Life was fully reinsured when they acquired it. And the new and renewal business uses a quota share reinsurance setup.
Meaning they share the risk and the premium.
Exactly. So the effect is that some income that might previously have shown up as a fee is now being recognized as premium income. It shifts where the income appears in the accounts, but importantly, it's still contributing positively just now to the insurance operating result rather than fee income line. So it's not necessarily a bad thing, just a change in presentation due to the structure.
Understood. Okay, let's circle back fully to asset managers and specifically that TPM business again. Overall commission income for asset managers was up 5% to 232 million.
And within that, the TPM commission income itself was up 6% to 146 million. They said this was driven by higher recurring income, basically fees on a larger average pile of assets under management.
They also reminded everyone that Q1 and Q3 reporting doesn't include income from real estate project development, right? That tends to land later.
Correct. That can be lumpy. They also talked about non-recurring income in TPM, things like performance fees. That was quite low this quarter, only 6% of total TPM income.
Which is way down from 31% in the prior year period.
Yeah, but last year's Q1 had some big revaluation gains boosting it. Management was pretty keen to reconfirm their guidance here. They still expect that non-recurring share to average around 25% over the full 2025-2027 program, and specifically for the full year 2025 as well.
Implying they expect more non-recurring contributions in the coming quarters this year to reach that average.
That seems to be the implication, yes. A normalization or increase from this low Q1 level.
Okay, let's really dig into that 9.3 billion TPM net new asset number. Just phenomenal compared to 0.7 billion a year ago. What exactly was the rocket fuel there?
It really stands out, doesn't it? Management pointed to two main drivers: a new index business offering and also strong performance in their active mandates. They even broke it down further.
Go on.
2/3 of that massive 9.3 billion inflow came from index products, mostly equities and bonds. Inflows into real assets were much smaller, 0.3 billion. Real estate was positive, but infrastructure saw slight outflows because they exited a specific portfolio.
And all those inflows, plus some help from currency movements,
pushed assets under management in TPM up to 135 billion euros. That's up from 125 billion just at the end of 2024. Significant jump.
What are they guiding for the full year NNA then?
They said expect it to be in the upper teens of billions. So maybe not 9 billion every quarter, but still very strong. They called the Q1 strength an opportunity, explicitly linking it to market events. Even mentioned a bank takeover that spurred a lot of requests for proposals they managed to win.
So capitalizing on disruption.
Exactly. They admitted they weren't sure how long that specific momentum would last, but they sounded very confident that the full year 2025 NNA will be significantly above the 2024 flows. They're pushing hard, they said.
And the index business itself, is it actually profitable at competitive prices?
They addressed that. Called it a volume business, yes, but profitable. Said it's competitively priced, brings in new clients, and importantly, contributes to their overall financial targets. The total AUM just in that index business is now around $14 billion, built up pretty quickly over 2024 and Q1 25.
Okay. Shifting gears slightly to the overall investment result, direct investment income up 61 million to 1.1 billion, driven by
Infrastructure, real estate, and equities were the main contributors mentioned.
and that non-annualized yield was 0.8%, up from 0.7%. They also talked about real estate again, didn't they? Still liking it.
Very much so. They reiterated it's a core attractive asset class for them, particularly good for backing their long-dated insurance liabilities. Matching long-term assets with long-term promises. Vacancy rates in their portfolio were stable at 3.1%.
And the fair value changes on that real estate.
Positive in Q1, about 0.2% non-annualized. But here's the key detail. They specified this was primarily driven by their Swiss real estate portfolio.
And their outlook for the rest of the year.
They expect further positive fair value changes for the full year 2025, again, mainly from that Swiss portfolio. For their European real estate, they're expecting stable valuations. It's an interesting divergence. They also touched on IFRS 17 accounting.
Right, how net investment yield impacts things differently now.
Yeah, it affects the CSM, the value of future profits, differently, but they stress the yields calculation is still very important for their local statutory accounts and gives that crucial cash flow perspective.
Makes sense. Okay, financial health check, solvency, cash, payouts. That SST ratio was estimated around 200% end of March, and still around there as of the call date.
Correct, holding steady around 200%. But there's a known event coming up.
The hybrid bond repayment.
Exactly. They're scheduled to repay a 750 million euro hybrid bond in June 2025. That repayment is expected to knock about 4 percentage points off the SST ratio.
But even after that, they'll still be above their target range.
Yes, they project it will remain comfortably above their ambition range of 140% to 190%, so plenty of buffer.
And liquidity at the holding company level looked quite high at 1.4 billion.
Temporarily high, they clarified, partly due to a recent senior bond issuance. You have to see it in context of upcoming payments, that 750 million hybrid, plus another 250 million senior bond, also due for redemption in June. So that cash has places to go.
And the share buyback, still on track.
Yep, 750 million program running until May 2026. They'd repurchased 230 million worth as of mid-May, so progressing as planned.
They gave some color in the Q&A on what moved the SST ratio during Q1, right? Even though it ended up back around 200%.
They did. Market movements had a mixed effect. There was a positive earlier in the quarter from the CHF-USD interest rate difference.
How the Swiss franc versus US dollar rates impact their hedges.
Right, though that benefit apparently lessened a bit by the end of March. On the downside, widening credit spreads had a negative impact, and equity markets were marginally negative too. But overall, they said sensitivities were in line with expectations, just highlighting the volatility they're managing, particularly in rates and FX differentials.
And the impact on future profits, the CSM.
They described the economic variances affecting CSM as we're sort of flattish overall as of the call date, maybe slightly positive since mid-March as that rate differential widened again, but year to date it had narrowed compared to the prior year, so some moving parts there.
Did they comment much on competitors, like the Helvetia Belize merger news in Switzerland?
They were asked. Their response was pretty much head down, focus on our own game, focused on clients, markets, opportunities. They pointed to their 40% market share in Swiss life as a position of strength.
And that clarification on revenues versus premiums was useful too. Why they prefer gross written premiums, fees, and deposits received.
Yeah, they prefer that metric, which grew 6% because it's their long-standing internal measure that they feel better reflects total business activity. The official IFRS 17 insurance revenue metric doesn't include savings premiums from life policies, so they argue the 6% growth figure gives you, the listener, a more complete picture of top-line momentum.
Okay, let's try and pull this all together then. What does this Q1 snapshot really signal for Swiss life?
Well, I think the call paints a picture of a company feeling pretty good about the start to its 2027 program. That 6% growth in their preferred activity metric seems broad-based, which is encouraging. Momentum in both insurance and fees.
And that TPM net new asset number, the 9.3 billion, that's got to be the standout positive, surely, driven by seizing that index business opportunity.
Absolutely. It's a massive driver for their fee income hopes and shows they can be pretty agile in capturing flows when market shifts happen. And they're pushing on active mandates too.
Looking segment by segment, France definitely looks strong with that life growth and high unit-linked share. Germany's showing decent underlying growth once you adjust for that one-off.
And a clear focus there on boosting advisor productivity and growing the trainee pipeline. And the Ellipse Life Point shows how accounting can shift things, but the business is still adding value.
The balance sheet looks solid, too. That 200% SST gives them room to maneuver, even with the hybrid repayment coming.
And don't forget that specific point about positive real estate value changes in Switzerland, contrasting with stable expectations for Europe. That's a nice specific detail for their investment outlook.
So overall, management sounds confident. Confident in executing the strategy, hitting targets, even while acknowledging, the market throws volatility at them, rates, FX, credit spreads, impacting things like SST.
Right. Now, let's move to our This Is Not Financial Advice segment. Remember, these are just thought experiments based purely on the transcript. Investing involves risk. Don't take this as a recommendation.
Okay, here's where it gets, as you say, really interesting. Based only on the specific things said in that call, here's an outrageous but plausible idea for you to think about. Go long Swiss life, but hedge it. Hedge it heavily with a short position specifically on non-Swiss European commercial real estate.
Okay, unpack the logic there. Strictly from the call transcript.
The logic is, management explicitly guided for further positive real estate fair value changes coming primarily from their Swiss portfolio this year. But they expect their European real estate portfolio to be stable.
Right. So the bet is that Swiss real estate really does decouple from broader European trends. If European or even global property markets outside Switzerland take a hit.
Swiss Life's specific portfolio might offer some relative insulation due to that Swiss weighting. The outrageous part is needing that Swiss market to hold up significantly better and timing it right. The plausible part is that management themselves highlighted this divergence in their outlook based on Q1.
Interesting. Okay, alternative idea. Still outrageous, but plausible.
How about a pair trade? Betting on Swiss Life's TPM business continuing to outperform relative to a, let's say, less agile competitor in the European asset management space.
Okay, the plausible angle there.
It's rooted in that huge NNA number they just pulled in, showing they can capture market share from disruption, like that index business win. And management said they're pushing hard for more NNA and active mandates too. They've demonstrated agility.
And the outrageous
Picking the right competitor who won't manage to adapt or catch similar tailwinds. And, crucially, betting that Swiss Life's massive Q1 NNA performance isn't just a one-off lucky break from a specific event, but reflects sustainable outperformance capability. High conviction needed there.
Definitely high conviction. So again, folks, these are purely illustrative ideas sparked by the transcript content. Absolutely not financial advice. Investing carries risk.
So let's wrap this up. Swiss Life reported a solid Q1 to kick off their 2027 plan. Broad growth, really turbocharged by those massive TPM inflows, especially in index products. Insurance segments, particularly France, looks resilient too.
Management acknowledged the market volatility impacting metrics like solvency, but sounded confident about their strategy, their targets, and they have that strong balance sheet underpinning things.
So what stands out most to you, the listener, after hearing all this? Is it whether that TPM momentum can last? Or maybe how quickly they can boost productivity in Germany? Or even just tracking how that Ellipse Life reporting shift evolves?
Lots to mull over. And remember, everything we discussed today came straight from the Swiss Life Q1 2025 earnings call transcript. The trade ideas, purely hypothetical exercises.
Thank you for joining us for this deep dive.